Good morning, afternoon, and welcome to our Dubai Real Estate webinar. Great to see so many people joining in London, New York, and Singapore. And this is exactly the global audience we wanted to reach today. All right, everyone, so let's just get started. My name is Hassan Waqar. I'm the founder and CEO of Hassi Properties. And today we're going to talk about something that's creating a lot of conversation in investment circles right now. Why London and US investors are moving capital into Dubai in 2026. This isn't speculation. This is a trend we're seeing firsthand with our clients. And today I'm going to walk you through and show you what we're seeing firsthand with our clients today. Just a bit of housekeeping before we dive in. So we will be recording the session, and don't worry about taking any notes. Every number I mention, every stat that I share, you'll receive a replay link via email within 24 hours. And I'll also be sharing with you the PDF summary of today's key points. Please use the question and answer box throughout this session to ask questions. I'll be monitoring them throughout. And if your question is urgent or directly related to what I'm covering, my team will flag it with me and I'll try to address this in real time. We'll be together for about 45 to 50 minutes of content, followed by 15 to 20 minutes of live Q&A. So plan for about 60 minutes in total. And I promise to respect your time and keep this valuable. So let's get into it. In today's agenda, we're going to be covering global markets, looking at the global property landscape, specifically what's happening in London, the US, markets that's causing investors to look elsewhere. Second, we'll dive into Dubai's fundamentals, the economic drivers that make this market different from what you're used to. And third, I'll give you a clearer market outlook, where we are in the cycle, what return, and what to expect in 2026. Fourth, we'll cover the quality program, because for many of you, it's not just about an investment, it's about an opportunity and lifestyle. Fifth, we'll talk about investment strategies, the practical know how structuring your investment, and finally, we'll floor up Q&A. This is a chance where you have the opportunity to learn anything or anything that. So let me quick intro on why you should listen to the first place. I'm Hassan Waqar and CEO of Hassi Properties. I'm Hassan Waqar, founder of Hassi Properties. I've been working in real estate for over a decade. More importantly, I've got investors from London and the US, Europe, who were in your exact position, trying to figure out if Dubai really makes sense. I'm a registered investment advisor, DLD certified, and I work exclusively on the buy side. What this means is I don't work for developers, I work for you. My job is to help you make decisions, not to sell you properties. And I've personally navigated the London and New York markets, so I understand where you're from today. And I'm going to give you the unfortunate truth about Dubai, the good, the challenges, and whether it's the right decision. Just a little bit about Hassi Properties. We are a real estate investment consultancy. We have an office based in London, New York, and Dubai. And why? Because that's where most of our clients are based. And we understand you need someone who speaks your language, both literally and figuratively. We are DLD registered, which means we're regulated by the Dubai Land Department. We provide independent advisory. We analyze the entire market and recommend what's best for you, not just what's best for us. And we have direct relationships with all the major developers, which means better access, better pricing, and faster execution. Why this webinar really matters for you? So let me guess, you're here because you've heard about Dubai, maybe from a colleague, the news, friends, family, and you've got certain questions running through your mind. Has Dubai peaked? Is this 2007 all over again? Am I thriving at the top? Is 2026 too late? Have I missed the point, or should I have invested 3 years ago? Is it even safe? What about the legal framework? These are exactly the right questions to ask, and to be honest, these are the kind of questions that I personally get when I'm speaking to investors like yourself. And here's what I'm not going to say. I'm going to give you the data, not the hype. So you can answer these questions yourself. And by the end of this webinar, you know whether Dubai really belongs in your portfolio or not. So let's start with the big picture, the global property landscape. So we've seen the news and across the markets, London, and we'll do a comparative analysis of both markets. So in London, we've got rising mortgage rates, increased tax burden, and shrinking net yield. Whereas in New York, we've got record interest rates, high property taxes, and yield comparison. If you take a look at London, for example, we're talking about 5 to 6% on mortgages, on mortgage rates. You've got increasing taxes, capital gains tax, stamp duty, mortgage interest deductions, and you've got declining yields. And good luck finding a property in Central London that yields more than 3 to 4% gross. Similar story in New York. Mortgage rates have been hovering around 6.5 to 7% recently. You've got property taxes in Manhattan and Brooklyn that can eat 1 to 2% of the property value annually, and rental regulations, especially in New York, are becoming increasingly tenant-friendly, which means landlord headaches. Now, I'm not saying don't invest in London or New York. These are mature, stable markets. But the math has now changed. The returns that made sense 5 years ago don't make sense today. And that's why investors, particularly high net worth individuals, are asking where else can they deploy capital that offers better risk-adjusted returns? And that's the question that we're really answering today. We're seeing a global capital shift. And what you're seeing here is a trend that's been accelerating since 2020. Capital is flowing out of high tax, low yield markets and into tax efficient, high yield markets. And Dubai sits at the center of this shift. Why? There's three particular reasons. Taxes. There's 0% personal income tax, 0% capital gains tax, and 0% inheritance tax. In Dubai, yields are 6 to 9% versus London, which are 3 to 4%. And the currency stability. The US dollar has been pegged with the dirham, which physically govern mature regulatory frameworks. Now, three things that make Dubai unique. First, again, 0% income tax, 0% rental tax, no capital gains tax, and inheritance tax. Second is the US dollar peg, no currency based investors. Third is a safety and stability. Dubai has no crime rate, political stability, business friendly environment, and English as a business language. Now, let's look at the Dubai economical fundamentals. There are four pillars that drive the demand in Dubai real estate. We're looking at population growth from 3.5 million to 5.8 million. Dubai just reached million at the end of 2025. We're now looking to go to 8 million by 2040. Business hub. We are the number one top financial center in the region, hosting over 70% of the Fortune 500 companies. Tourism, 17.1 million tourists visited in Dubai in 2023 alone. That's now going up by more than 20 million in 2024. And now we're targeting 25 million by 2027. And we're seeing a huge shift in infrastructure changes. Billions of dirhams are being spent in new metros, roads, and the world's largest unmanned international airport. Now let's look at the Dubai market snapshot. So in 2025, Dubai recorded a 28% year-on-year growth in transaction volume that accounted for 178,000 transactions, whereas the market value was over 890 billion, which is 1,805 billion US dollars. The average growth has been 7 to 8% this growth, and we've seen a 94% occupancy in prime areas, with gross yields growing between 6 to 8%, depending again on the area. And we're seeing that shift move into different areas such as Dubai, Palm Jebel Ali. We're also looking at equity. Now, this is a very common question that we get asked: is where are we actually in the cycle? Now, Dubai, obviously, we had a growth phase. We then moved into the peak phase. We are now at a stabilization phase. This is now normalizing. Rental yields are coming up. There are speculative capital exits. In 2021 to 2023, we've seen a 55% annual gain. The peak was mid-2023 to early 2024. Now, 7 to 8% growth, stronger yields, fundamental driven, and this is the best time to enter for profitable returns. Now, if we look at global two-year comparison, London sees a 3 to 4% growth. New York 3 to 5%, Dubai is growing 6 to 9%. That's 2 times higher compared to London, New York average. And then if you look at the tax comparison, as I said, so in the UK, rental income tax is taxed between 20 to 5%, capital gains between 18 to 24%, and the transfer fee on stamp duty is between 3 to 12%. Similarly, in the UK, we're seeing a rental income tax of 10 to 37%, capital gains between 0 to 20%, transfer fee between 2 to 5%. Whereas if you go into saying any rental income tax, no capital gains tax, and transfer fee is just 4% by land registration charge, which is purchased across any property, whether it's retail, commercial, land, or residential. Now, here's the most important thing which we need to talk about. It's a Dubai economic agenda. So what is happening over the next 10 years, 33? And there are six key areas that Dubai is looking at. Number one is the relative GDP target. Dubai is targeting 32 trillion, which is doubling the size of Dubai's economy over the next decade. We're then looking at trade at 25.6 trillion dirhams. Foreign direct investment, this is money coming into Dubai, we're looking at 650 billion dirhams. Looking to be the top three global economic cities, over 100 different transformational projects which are scaling up the private sector growth and innovation, and 400 city trade corridors, so that expanding the logistic and trade network globally. And then following that, let's look at Dubai 2040. So Dubai 2040 is broken down, but the key one, 5 urban centers that Dubai is planning to focus on, and that is downtown, Marina, Expo City, and Silicon Oasis, creating 60% of space, 80% population within 800 meters of public transport, 300 increase in the public beach access and length, and 5.8 million residents living in Dubai by 2040. Now, here's the most important part, is how is my investment regulated and safe? Dubai Land, which was formed in 1960, is the overall governing body of Dubai real estate, followed by the Real Estate Regulatory Agency. Now, there are five key points of it. Number one is obviously escrow. So whenever you purchase a property which is off plan, your funds do go directly to the developer. They sit in an escrow account and they are released only upon construction milestones. There's a system which is a mandatory registration of property ownerships, and that obviously protects you as a buyer and investor. We have an RDC, which is a dedicated rental dispute center for fast-track legal arbitration for any rental disputes, full transparency in the market via the Dubai REST platform, and strict licensing. That's across developers, brokers, and advertising across the markets. Next, we look at plan and ready properties. So off-plan properties have lower prices. We're looking at typically 10 to 30%, even up to 50% depending on the time and entry level to. Below market this is already you're on an interest rate plan, typically 20% payment, 40% during construction, 60% on completion, 50% during construction, 50% on handover. You're looking at a much appreciation, latest design, smart home technology, brand new amenities. There's all consideration. We're looking at wait time, which is no immediate rental income. We're also looking at market risks, which value on future market considerations upon completion. That's the best investment strategy for capital appreciation and long-term growth. I'm just hearing that there is some sound issues coming up. Just bear with 1 second. Movement should be clear now. If there is anything, please just raise your hand or let me know in the comments so that I can just double check. I'll just give it a few minutes for people to just respond back to me to see if the sound is working. Right, I'll continue. And if there's anything with the sound, please feel free to reach out via the chat and I'll just adjust the mic. So I'll just go back a little bit, just talk about, I believe there was a few issues. So we'll just go back a few slides, just making sure that we cover. We'll go back to the regulatory slide. So as I mentioned before, just before the sound obviously got disconnected, so I do apologize for that. So Dubai Land Department is a government agency which has the overall responsibility of managing the real estate market in the UAE, followed by the real estate regulator, which is the regulatory of Dubai real estate. Now, the reason why we have this is for investor protection, and then there are 5 key points which are very, very important to you as an investor. First of all, is the escrow account. So whenever you're purchasing in an off-plan property, you always have an escrow account which your funds get deposited to. These are only released to the developer upon completion. Second is the accrued system, which is a title deed system. So every real estate sale gets registered in the accrued system, and you get a title deed based on that. Then we have a dedicated RDC, a rental dispute center, which handles all rental disputes between you as a landlord and the tenant. We have full transparency when it comes to market data via the risk platform, and strict licensing. So all advertising, all developers, all risk brokers, consultants, they are regulated, managed by the Dubai Land. Now we move on to the off-plan versus ready. So there are two markets. One is obviously off-plan, just to give you a bit of insight into what an off-plan is. Off-plan is basically properties that are currently under construction. So you have low entry price, typically 10 to 30%. This can go up to 50%, again, depending on the area and the time that you enter into an off-plan project. You're on an interest-free, flexible payment plan. Typically, the down payments are 10 or 15 or 20% down payment, and then you're paying 40% during construction with 60% on handover, 50-50. Again, that depends on the developer and the project at the time. So the third most important thing is the capital growth. So you're looking at high capital appreciation potential during the construction phase. And then you're looking at modern standards, so latest designs, latest technology, and brand new amenities. The considerations you should take when you're looking at an off-plan property is wait time. So there's no immediate income. You have to wait until handover. That is then typically 2 to 4 years, and dependent on when you enter the market and also when the handover project is. And there is a market risk. The value depends on the future market conditions upon completion. This is the best investment for capital appreciation and long-term growth. Now, if you move over to your property, you buy a property, it's ready to go ahead, and your rental income starts from day one. It is a tangible asset, so you can expect the actual quality, the location, amenities before you buy. And you are looking at established areas which are fully developed in community infrastructure. And there is opportunity and value upgrades renovation when you come to flipping. The downside is high upfront costs, requires a 100% payment or more deposit, 20% plus. And you're looking at maintenance, which is potential repair costs for older units and aging facilities. But the best investment strategy for that is immediate cash flow and rental yield. Now we move on to the financing options. So in Dubai, there are 3 different ways that you can finance your purchase as a UAE resident, as a UAE resident. Number one is a cash purchase, which is zero interest cost, no bank fee, 100% ownership immediately, stronger negotiation, price discount, and faster transaction time, usually within 30 days. If you payment, it's interest-free financing from the developer. You're doing the down payment 10 to 20%, and monthly installments can be between 5% to 1%, again on the developer, and the post-handover plan available again depending on the project and developer once your property is ready to be handed over. And the third option is bank mortgage. So loan to value for UAE residents is 80% and 50% loan to value for non-UAE residents. Interest rate is 3.9 to 5.25, depending on the profile, and if you're a resident or a non-UAE resident. And you're looking at both conventional and Islamic finance options, and also long tenures up to 25 years. Now we'll move on to the investor protection framework. So there are 6 mechanisms. Again, one of them is the escrow system, which we already covered, funds being deposited into an escrow account, released based on completion. DOD, the title deeds, government issued ownership, documents providing indisputable proof of ownership. The accrued registration is the interim registration protecting off-plan buyers. So you do get a pre-title deed, which is called the accrued. Legal recourse, where it provides fast-track tribunals for real estate disputes. We are licensed. The Dubai real estate market is a fully licensed market. So you have to make sure that you are working with a licensed broker, licensed developer, escrows are in place already, and the other documents obviously meet the DLD standards. And ownership. Clear freehold laws for owners with 100% ownership rights and zero capital gains tax and transparent inheritance procedures. Just one thing that I want to add on to this, which is not covered in this slide, is Dubai real estate is 100% freehold. There's no lease. There are certain areas where there is a lease applicable on that, but at that time, obviously, you as a non-entity, you are not eligible to purchase the property over there. So that's just one key thing to understand. Other markets such as the UK, US, you are on a it is free completely. Now here's my favorite. Right? So what does $1 million buy in Dubai? Uh, Compare that to all the major markets across. In Dubai we look at 105 square meters compared to London, which we look at 45 square meters, New York 40 square meters. So it's better value. You're looking at 2 to 3 times more value in Dubai real estate compared to your London and New York real estate. But also you're looking at New York 3 to 5% rental yield, London 3 to 4% rental, and Dubai obviously outperforming that at 6 to 9% rental yield. Now Dubai real estate is not just about buying a property, it's also about the residency. It's also about what is available for you as a investor. So Dubai has a golden visa. This is a 10-year residency visa, which is renewable every 10 years, as long as you have the value of the property invested in Dubai of $2 million. This can be split between two properties, or it can be one property. Again, 100% foreign ownership, business and property assets. You can sponsor your family, your children, your parents, maids, and drivers. There's no limit on how long you stay outside of Dubai or in Dubai once the visa is active. You also do get other benefits across the whole market. Now, the thing over here is that we need to understand the down payment on a plan when you are eligible to apply for a golden visa is at 20%. So once you've done the 20% plus the 4% Dubai Land Department fee, you are then eligible to apply for your golden visa straight away. That rule changed recently. Before it was, you had to wait for the property to be completed at 50% rather than you have to wait for the property to be completed at 50%, and you've had to pay 50% for you to then apply for the golden visa. And this golden visa is renewable again, once I said, every 10 years. You can resell your property, but as long as you invest again and the value of the assets go above $2 million, you are eligible to continue your residency in Dubai. Now, let's talk about the buying process when it comes to Dubai. This is a very generic system over here. Just give it a couple of seconds just to see if the sound is okay. Cool. So, the buying process in Dubai, we're looking at 6 steps. You've got identify the property, the budget based on what you're looking for. We'll reserve the unit, typically with a down payment of 5 to 10%, sometimes 20%. There is a sales purchase agreement issued by the developer. We're looking at a payment, 4% DLD registration fee, and the first required installment. That then gets registered in the Accord system, and you get a title deed in your name, and then you wait for the handover. That is an off plan, but on a ready property, it's pretty straightforward. You have the property, you either take it as a mortgage or you pay full cash. We go to the trustee office, and that just gets transferred over into your name. Then it's a pretty quick process. All in all, if we are looking at a ready property, the transaction time can range between 24 hours to 30 days, depending on obviously the buyer and the seller. We've covered the financing option, but just a quick recap. Cash, immediate ownership, no interest. Mortgage, 15 to 25% down payment if you're a resident, or 50% if you are a non-resident. 4 to 5% interest rate. Developer plan, 10 to 20% down payment, interest free, spread over 2 to 5 years, with a potential for post handover payment plan. And most clients mix developer plans, off-plan growth, mortgage, cash, or ready income. So you, depending on obviously your finance needs and your needs as an investor, that can obviously differ. And let's just take a look at investment strategies again. 4 strategies: off-plan growth. Off-plan is for growth, where you're looking at pre-construction and you're looking at obviously capital appreciation. Ready properties, immediate cash flow. Rental income, again, immediate cash flow. And appreciation is long-term hold. You typically hold property for 5 to 10 years, get the significant based on the area and infrastructure that's coming around. Just to give you a case study over here, these are actual case studies. I've just blurred out the name for obvious reasons. But one of my clients, they purchased a property worth 2.1 million dirhams. just recently. Actually, it was a rental property, looking at 7 to 8% in London. The net yield was 7 to 8% compared to 3.5% in London, with a 15% capital appreciation, and saving over £12,000 in taxes in that year. And then similarly with a US investor, we had an investor that purchased a property for 1.2 million with a net ROI of 7.2. Again, this was off plan. Currency risk is zero, property tax zero. There's no growth in the year because it's still under construction. So you can see based on the investor profile, what we are looking to, what you as investors looking to do, there are different profiles, different scenarios that can work when it comes to your investment in Dubai real estate. I see this happen all the time. A lot of common mistakes are being made in Dubai real estate, and it's very, very important that we address these. You, as an investor, it's important you notice. Number one, don't chase for the cheapest prices. I see this day in, day out. People going for the cheapest unit because they want to own a property in Dubai. That's not an investment. That's just showing off that you want to buy a property in Dubai, right? The reason behind going for a cheaper unit, you're looking at high quality, maintenance costs, harder to resell the unit. Unknown developers. Always go with a developer. Imar, Nakil, Miras, Dalak, Shok, Bengati. These have track records in the market, and I'm not saying there are other developers that don't have track record. There are a lot of other developers, but you should always, do your due diligence on the developer. Have they got any delayed handovers, any cancelled projects, or, finishing is not as great. Any developer or anybody promising you a guaranteed rental income, just stay away with that. Can guarantee that. That's based on the market. And not having an exit plan. I see this all the time where people are looking at buying a property, they're looking at the rental income property, but there's no exit strategy, right? You need to understand where will you be when it comes, 5 years, 10 years down the line. What are you going to do? Are you going to sell it? Are you going to keep it? You need to have that exit strategy in mind. And that's where we come in and we assist you with planning out your exit strategy across the market. Just coming to an end over here. So where smart money is growing. Where smart money is going. So we've got 4 investment corridors in Dubai. We've got Dubai South, Expo City. This is the area here where we see huge potential growth due to Al-Maktoum International Airport, the Expo 2020, universities, villa communities. We're looking at 70% rental yield with a 3 to 5 year maturity. Then if we looking at Dubai Creek Harbour, right? This is Imar's mega project. It's the next downtown waterfront metro connectivity. Here we're looking at apartments and penthouses with 2 to 4 years as key phases. Then we've got Balali, which is over here, right? Palm Jubilee is twice the size of Palm Jumeirah, where we're looking at villas, apartments, plots. Anybody that in Palm Jumeirah, would obviously know what happened in the appreciation on Palm Jumeirah, where villas at that time were 5 million dirhams and now being sold at 100, 200 million dirhams. And then we Dubai Hills Estate from this side over here, again, villa community. Here we're seeing an influx of infrastructure being developed by Imar, more family friendly, executive friendly. So there are 3 things that are really defining Dubai real estate. Number one is obviously the strong demand by high net worth individuals who we're seeing moving into Dubai. We've just seen 7,500 millionaires migrate from London, from the UK over into Dubai. There's a very controlled supply of property. The government regulates the phased handovers. So that's preventing market saturation and maintaining a healthy appreciation. Because what happens is you have so many units being delivered and obviously reduces the property value because then there's a lot of competition in that market. And then quality of developers, again, focused on tier 1 master developers, Imar, Nakil, Plus. They ensure high resale value and liquidity. And why Hassi Properties? 4 reasons we're different. Number one, independent advisory. We work with you and not the developers. We're not incentivized to push one project. We analyze the market objectively. Number 2, data demand. It's our data-driven approach. We show you the numbers, the yields, the trends, the supply, the demand, and the decision based on the data, not emotion. And we give you the full data that is required for you to make that informed decision. Again, full transparency. We don't charge you on a on a property purchase if it's off plan. If it is already, there is a 2% agency fee. Other than that, there's no cost. There's nothing like that. Don't promise you any potential returns up front. We're honest and transparent as it can be. And with market expertise, we have deep expertise combined with international standards, and that helps you navigate the real estate market securely and efficiently. Now we're coming to the end. Thank you so much for joining the webinar. You've obviously, are more than welcome to ask your questions in the Q&A, and it's open. But what I really want to do with you guys on the webinar you've attended is to have a 15-minute discovery call just to understand your goals and your interests in buy real estate. So feel free to send me an email or send me a WhatsApp. You can scan this QR code, which will take you directly to my profile, and then we can take it from there. So I'll open it up to the floor for any Q&As. But while I'm waiting for question and answers to come in, we've got some really common questions that come in all the time, so I'll answer them for you. So can I get a mortgage on new resident? Yes, you can. Typically requires 50% down payment, with interest rate typically 4 to 5%, and some banks are foreigner friendly. What is the total cost beyond the purchase price? You need to book 4% of finance transfer fee across both ready and properties. The second thing is 5 to 10,000 euros, which is the legal admin service charges on an annual basis. How do you repatriate rental income and capital? There's no restrictions on that. You're more than welcome to take out the money from the country. At the end of the day, it's your money when you bank transfer. It's smoothly on a monthly and quarterly basis. What if I sell my property? Again, just with the broker, we handle that. We'll sign the sale agreement, transfer the title deed. Typically takes anywhere between 24 hours to 30 days, depending on obviously you and the seller at that time. So I'll leave it all open to the floor for any questions that you may have before we end this webinar shortly. Right, I believe the question: do I pay tax on my investment property if I always lived in the UK? Why is my foreign income tax because I'm domiciled in the UK? A very good question. Again, I'm not a tax advisor. We don't give tax advice, but I'll give you a bit of an overview of this. Yes, you are taxed in the UK. However, there are structures that you can put in place to minimize that, to minimize your tax burden on a foreign investment. I'm more than connect you with a tax consultant who can advise you. So I'll reach out to you, and we can definitely have this conversation to assist you. We'll keep it on for minutes. Any questions may come up. Great. Don't think any questions coming in. What I will do is reach out to you individually, and you can schedule a follow-up call to discuss your interest in real estate. So thank you so much for your time today. I hope this session very valuable, useful. I will send this across to you via email. You'll get the link. shortly by email. And I'll definitely be reaching out to you, but you're more than welcome to reach out to me as well for any independent questions or advice that you need when it comes to investing in Dubai real estate. From wherever you are in the world, have a good evening, good rest of the day, and I hope to speak to you soon. Take care.